Regulatory reforms in the wake of corporate scandals like Enron and WorldCom yielded sweeping changes to the way that research reports are produced on company stocks. Since 2003, investors are supposed to receive independent research reports to help them evaluate their investments. Wall Street brokerage firms were even forced to set aside money to help finance this new research from more independent competitors. How effective have the reforms been? Are things really better now? I'm Sarah Bartlett, and this is our topic today on USA Inc. Joining us today is Charlie Gasparino, a CNBC reporter and Newsweek.com columnist who has devoted most of his journalistic career to covering the behavior of Wall Street firms. Charlie, thanks for being here today.
Misbehavior.
Misbehavior, unfortunately, yes. Tell me a little bit about the reforms that Eliot Spitzer made in the area of independent research and why he felt that was needed.
Right. Well, I mean, the whole area of research on Wall Street has been a much sort of very controversial, much debated area for many years because a lot of people suspected that there were so many positive ratings, like buy ratings on these stocks, because these companies were actually, the Merrill Lynch's, the Morgan Stanley's, they were engaged in investment banking business with the same companies that they were covering. So there was a conflict of interest, and there was all these buy recommendations on these stocks. And lo and behold, in 2000, the market blows up, and the public is looking for answers, right? And who comes to their rescue? Well, it's not really the SEC. The SEC kind of thought this was yesterday's news. But Spitzer, Eliot Spitzer, the New York Attorney General, gets a tip. He actually follows up on a story that I wrote at the Wall Street Journal, in which Henry Blodgett, the once famous internet analyst at Merrill Lynch, allegedly did a retaliatory downgrade on the stock when Merrill Lynch didn't get a deal. It was kind of the flip side of the positive research. But that investigation, bringing in Blodgett, interviewing all these people at Merrill Lynch, kind of opened the Pandora's box of Spitzer to this whole world. Now you have to realize, Spitzer is the New York Attorney General. What is he used to doing? Well, they do Medicaid fraud, they do nonprofit fraud. They don't really take a look at Wall Street, but here they were, a fresh face, and they said, wow, this is interesting. It's all these conflicts. And not only that, it looks like from these emails that people like Blodgett were telling the public to buy these stocks, but in private, in these private emails with their friends in the office, they actually thought that these were kind of lousy stocks.
Now, why would journalists not have noticed that there were never anything but buy recommendations on stocks?
Well, journalists did notice. I mean, that's the whole interesting thing here. Journalists wrote about this for years. We don't have the ability to get a smoking gun. I mean, sometimes you do. Sometimes you get a memo, as you know, but we don't have subpoena power. We can't say, Merrill Lynch, Henry Blodgett, turn over your emails. The SEC could do that, but they didn't. It was kind of interesting. They never took that extra...
They knew about it.
They knew there was a controversy here, but they never took the extra step to try to prove that there was a real problem. Now, why is that? Well, part of it was, I think, laziness. The other part is, in the back of my head, I wonder if they wanted to rip off the Pandora's box and actually see how dirty it was, that they might have to, it might be a criminal fraud case, which could really take out Wall Street. I mean, the SEC does worry about, Wall Street as an institution existing for liquidity purposes. I mean, without Wall Street, you might not have an economy, let's face it. Spitzer didn't care about that as much. He's a former prosecutor, used to work for the Manhattan DA's office, worked on mob cases. He saw this as a simple case of fraud, and he was looking to push it about as far as he can. He went in and he basically did a very good investigation of Merrill Lynch, found out that there was these emails from Henry Blodgett and others where they were promoting stocks to the public but telling their friends these weren't such great stocks. There was a sort of basis of a potential fraud charge. In the end, he chose not to charge Merrill Lynch with fraud, but basically to craft a settlement where they would pay a bunch of money and agree to some reforms.
Well, let's talk about the reforms. What happened now with research? What did he do to clean the mess up?
You have to realize that was the first step. The second step was opening up the investigation to Wall Street, doing a massive investigation, finding even possibly more egregious activity. There's one email which Jack Rumman, the former top-notch analyst at Solomon Smith Barney, says, he upgraded a stock to help his kids get into a preschool, the 92nd Street Y. Sandy Weil wanted him to upgrade. Sandy Weil was the CEO of Citigroup, wanted him to upgrade the stock of AT&T because on the Citigroup board was the head of AT&T. And in return, Sandy turns around and helped him get his kids into school. amid all this, when this was all sort of hashed out, I did a lot of reporting. I was actually the first to get these emails and actually other documents to show there was a lot of substance to this quid pro quo. Actually, it was called kid pro quo for a time. Spitzer came up with a set of reforms. And the reforms are essentially to create bigger Chinese walls than already existed.
Why don't you explain what a Chinese wall is for those who might not be familiar with the term?
It's a legal term, essentially, that it's a legal separation between two business units that have conflicting sort of duties. Like, you don't want your analysts to know what your traders are doing, because, or the traders know what your analysts are doing, because the traders can trade off that information. It's essentially insider trading. The same thing with investment banking. You don't want the investment bankers telling the analysts what to do, because the analysts are supposed to be independent. That research is being filtered through a brokerage network, which people like you and I, we buy stocks and we're influenced by that research. So you don't want the influence from investment banking sort of polluting the research. That's what Eliot Spitzer did. In many ways, it was a half-hearted effort, and I'll tell you why. Because his initial goal was to make research independent, was to essentially spin out the research unit, create a separate profit and loss statement where research would have to, either make or break it on its own. If it didn't, cast it aside. It's not needed. What he did was he built a bigger Chinese wall, but kept research in the sort of same genre, the same units, same business units with investment banking. Investment banking still, to this day, pays for research. So what he did was create some bigger Chinese walls, but kept the structure the same. And I think it's been problematic from that standpoint. There's still a lot of positive research because of that. Now, in addition to that, he tried to set aside some money that would go to quote-unquote independent researchers.
Truly independent. So not a part of Merrill Lynch or Prudential.
Independent of investment banking. But what he forgot is that these independent units, as we're seeing now with this whole situation involving an independent research firm called Gradient Analytics and a company called BioVale, that these independent firms may not be so independent either.
Okay, so the concept, though, just so we get that straight, is that there's an independent firm who's doing research without all of these conflicts that a Wall Street investment has. And they would, and if I'm a customer, let's say, of a Merrill Lynch, would I get the Merrill Lynch stock research and then from an independent firm as well? Yeah,
under the rules, the research settlement, now a lot of firms had to pay money, then they had to abide by these rules. And you get several types of research now. You get Merrill Lynch's own research, but you get two forms of quote-unquote independent research, where whatever Merrill Lynch wants to give you from
so
a quote-unquote, they get to pick from an independent source. And this covers the gamut. I mean, there's a lot of small firms. There's a lot of big. Standard & Poor's has some research that they're providing. There's a company called Argus that provides quote-unquote independent research.
Well, theoretically, then, if this independent research world is thriving because of the money that's been funneled into it, isn't the world a better place?
No, because the independent research is not that independent. Because they make a lot of their money not just from from money that Spitzer's providing through this research settlement. And by the way, it's been what, 3 years since that settlement, so some of that money is running out. I think there was a 5-year window on how much money would be funding the quote-unquote independent research. But they also make their money basically by serving sophisticated investors like hedge funds. And the long and short of it is that the hedge funds request and often pay for reports from these firms. So instead of the conflict that you get of investment banking, where banks were, the Merrill Lynches were piping stocks of companies that were investment banking clients. So the investment banking client was actually paying for the stock. You have something different. You have the buy side, the sophisticated hedge funds that are requesting reports of these independent researchers and actually buying that. So there's still a conflict. Now, it's not an investment banking conflict, but it's still a conflict.
Just again, so I understand, these hedge funds are generating research. That research is for them, or that research is for a retail network of investors?
Well, that's interesting. It's for them, but it often gets publicized broadly, and that's
so. In other words, the research firm says, "Well, gee, I did the work for the hedge fund. I might as well share it with all my retail clients."
Yeah, or my other customers. In the case of BioVale and Gradient Analytics, BioVale is a drug-making company. Gradient Analytics is an independent research firm. Apparently, the research that Gradient did on behalf of SAC Capital, which is the massive hedge fund, on BioVale, it's a negative report. SAC had a short position on BioVale, meaning that it wanted the stock to go down. The report was negative. It requested a negative report.
It requested it?
Yeah, what happened was they have this sort of client relationship where they get to request a report, and they wanted a negative report on BuyAvail, and that's what they got. That report got filtered to other Gradient Analytics clients, and possibly also the press, which gives it a little extra momentum. So it really wasn't pure independent research. Now, just so you know, full point of disclosure, Gradient says it was independent, that their research was their own.
That they were negative for
real reasons. They were negative for real reasons. SEC didn't order them to write it. They can't. It's their opinion. That may be true, but what the SEC is kind of looking at all this, saying, okay, what qualifies as truly independent research? And what you'll see is the second leg, I believe, of this whole research debate. First it was the investment banks. Now it's going to be the independent research firms. How independent are they, and which ones should be considered independent and which ones shouldn't?
And what's the answer to that? I mean, if you're an investor and you get this stuff across the transom, how are you supposed to know?
Now, this is pure opinion. My view is that any time it's paid for research, it should be disclosed as paid for research. I mean, listen, I could call myself...
Isn't all research paid for?
It is, but it depends on the relationship. I mean, if I order you're the research firm, to do a report, and I'm paying you specifically for that report, it's different than if you just do a report and then I buy it. You know what I'm saying? I'm buying it for the research, buying it for the analytics, buying it for your thoughts about a company. That's a little different. That's more of a passive relationship. But I'm talking about when there's an active relationship between the buyer and the seller of the research. I think that has to be more better disclosed.
And it's not right now?
I don't think so. I mean, in this report from Gradient, that whole thing, the whole client relationship was not clearly disclosed.
Wasn't a big red arrow saying this is to be taken?
Well, it just should have said SEC Capital paid for this report.
Right.
It would have been nice if it said that. Now, they still claim it's independent because they could have walked away from it at any time, and SEC requested the report. It wasn't a direct payment. It was they were a client of Gradient. As part of this client relationship, they get to request a report. At least this is how they used to do it. They don't do this anymore probably for obvious reasons.
Right. They've
changed their minds on this whole thing. But still, it is clearly something that I believe should be disclosed. And just let everybody know what's going on. It's not a bad idea.
Right. And we'll see. I guess the SEC is looking into this.
It's weighing in. I mean, who knows what's going to happen. This whole debate got very muddied because they're also looking at potential stock manipulation, by SEC. SEC Capital denies all this. BuyAvail is a company that had some troubles in the past, so a lot of people say maybe the stock should have been crushed, which it did after these reports. It went down fairly significantly. I think it went down from a high of 50 to 13 or something along those lines. It's back up to in the mid to like late 20s at this point.
Okay.
But this is a debate that the SEC is having internally. What they should do with this, and who knows where they're going to come out.
We'll be right back.
The Zicklin School of Business at Baruch College of the City University of New York is the largest and most diverse accredited business school in the United States, offering high-quality, full-time and part-time degree programs at the undergraduate, master's, and PhD levels. For information about the Zicklin School of Business, please visit our website, zicklin.baruch.cuny.edu. That's zicklin.baruch.cuny.edu.
Welcome back. I'm speaking with Charlie Gasparino, a CNBC reporter and Newsweek.com columnist. Given this situation where the conflicts are now slightly different than we thought they were, and it's more complicated, what should an individual investor do? Should they just regard these reports with a grain of salt?
I think so. I mean, I think, it's buyer beware out there. I do not believe in buying individual stocks unless you really know the company. And I think when you do, you're always taking a leap of faith. So for that standpoint, I don't think research means much for me, for individual investors. I mean, I think you're better off investing in a S&P 500 fund or whatever sort of index fund sort of matches your risk tolerance. If you have high risk tolerance, maybe buy lower cap stocks. Or if you want to buy tech stocks, buy an index, buy something that's broad-based where you diversify your risk, even if it's in a risky sector. That's why I do not believe that individual stocks are good for individual investors, because it's impossible for individual people to have enough knowledge of the market. Unless you're a trader, unless you're someone that's in the market, you can't tell the nuances in these reports, and they're heavily nuanced, and you don't know what to look for. A lot of sophisticated investors. One of the great things during the big fallacies during the 1990s was that all investors got ripped off. Well, not really. A lot of sophisticated hedge funds didn't. When they would see Mary Meeker's report, they would throw out, or Jack Rubin's report, or Henry Blodgett's reports. They wouldn't look at the stock rating. They would look at the analysis and see, let me get some insight into the industry, because that's what they're good at. They knew the stock ratings were hyped that they didn't mean that much. But individual people's, average people that went to their broker at Merrill Lynch, they didn't know that. They weren't let into that game. They're not smart enough. So that's where they got screwed, so to speak. So I believe you just sort of ignore all this stuff and try not to be a stock picker. Try to be a long-term investor and try to be diversified. But think of index funds because they sort of hedge your risk a little bit.
I mean, maybe was there any point in trying to preserve this research industry? I mean, if it's really of so little value to an individual investor, why put all this taxpayer energy into enforcing an industry that sort of seems like it's almost an anomaly at this point?
You should ask that question to Elliot Spitzer. That, in my book, Blood on the Street, that was one of the big criticisms I had. I mean, early on, Elliot Spitzer had a brilliant idea. He said, let's spin it off. Let's take the research department. Let's break it out of investment banking. Remember, investment banking generates all the fees, not the research. That's kind of like an add-on thing, right? That helps promote the investment banking. So break it out, and if you really can sell your research as good research, if investors are going to buy it, well, it will become a profit center. Wall Street went crazy. They basically sold them on the argument, if you do that, you'll lose jobs in New York State. You know, researchers won't be working. There won't be any research. As you know, that'll be a fundamental change, not just to the employment picture of New York State, but also they believed it could hurt the capital markets. That was an argument that they made. I don't agree with the hurting the capital markets argument that researchers were needed for the capital formation process, that they had to get the word out for these stocks. Because most people don't believe that. First off, most sophisticated investors who buy on the initial public offering, they don't look at Wall Street research. They do their own research. They pick it up for tidbits of information. Average investors, well, you know, quite frankly, what they look for on this is the stuff that's not really needed. You know, it's the stock rating. They don't get into sort of the huge numbers, you know, the sort of detailed numbers crunching inside. So my view was that Elliot Spitzer blinked on that. You know, Wall Street really would have fought him on that, I believe. So, you know, I don't think he was up for a knockdown, dragged out fight, although he did have tremendous evidence, and he did have something else, something called the Martin Act, which is a New York State law, which allows you to essentially charge someone criminally for a traffic ticket, you know, the equivalent of a traffic ticket. So I think he could have done it. I think he blinked on that, and what investors should know is that this stuff should not be trusted.
Now, the SEC, as you said, was really sort of missing in action during this whole period. How do you feel it's doing under the new chairman, Chris Cox?
Right. I mean, I think the person who's responsible for the SEC's problems, I think largely was the guy that thought it was, you know, became the sort of exemplar of the individual investor. And that's Arthur Levitt. I mean, he really was asleep at the switch. He got involved in sort of a lot of minutia when he really didn't pay attention to the sort of issues that were driving the small investor, which, you know, stock research, for better or worse, even though it was covered like crazy in the Wall Street Journal, not every individual investor reads the Wall Street Journal or the New York Times. You know, they read the New York Post and other papers. So I think Levitt fell down on the job. I think Harvey Pitt, for all his negatives, Harvey Pitt was George Bush's appointment, you know, succeeded Levitt for all his negatives, and he had some negatives, mainly in the public relations. You know, he wasn't very good at promoting himself, unlike Arthur Levitt. I thought he did a pretty good job. He ramped up the investigations. He went after Wall Street in a way that, you know, the SEC didn't go after him during the Levitt administration. However, you know, from a public relations standpoint, he used to work for a lot of these Wall Street firms. Spitzer sort of mischaracterized or spun his, you know, Harvey was a little reticent about joining Spitzer right up front in this crusade on Wall Street research. Didn't think that Elliott was in it other than for the publicity. And Elliott was able to successfully spin that Harvey Pitt is like covering up for his buddies on Wall Street, because, like I said, he was a Wall Street lawyer. After that came Bill Donaldson, who kind of stabilized the place, and now you have Cox. And I'm not sure how to grade Chris Cox just yet. I think one of the interesting things is that he is not rocking the boat at all. Most people thought he'd come in, he's a conservative Republican, that he'd come in and somehow try to roll back Sarbanes-Oxley, which was the big sort of anti-corruption law, which forced all these companies to do all this extra disclosure. Some small companies say the burdens of complying with Sarbanes-Oxley are so onerous, you know, they're putting them out of business. They have to become private companies, or they have to merge. And I really thought that Chris Cox, being a Southern California Republican from Orange County, a type of guy, free marketeer, you know, one of the real free marketeers in Congress. He was a congressman from Orange County, would come in and try to roll that back, and he hasn't. He's run a very status quo, staid SEC, and maybe that's what it's needed. They just need to do their job and not create too much, you know, headlines. Although, interesting enough, they did create headlines by trying to subpoena journalists recently in this whole issue regarding investigations of hedge funds.
Yeah, what do you make of that? Is that an attack on the press?
I don't think so. I mean, I think that the SEC, knowing the people, I know the people in the enforcement division of the SEC. A woman named Linda Thompson heads the SEC's enforcement division, and these are not like wild people. These are not like, you know, crazy cowboys. They must have, now I don't know everything about the investigation, but they must have some reason to think that journalists, and I don't think it's winningly, I don't think these journalists, you know, are part of the scam, but that somehow the information flow that might have caused a fraud on the stock in question, one is buy avail, one is overstock, that journalists had to play some passive role in this, you know, actively passive. I mean, they didn't do it on purpose, but their reporting helped. Yeah, and they must think that, if there is a case here, and I don't know if there is a case. And, you know, it's not unprecedented for journalists to be called in as potential witnesses. It is something that the SEC rarely likes to do, but, you know, this does happen. A lot of times what happens is that you don't hear about it. You know what I'm saying? I know a lot of my work, I mean, I wasn't called in as a witness, I wasn't subpoenaed, but people, you know, I've seen depositions where my work is openly bantered about, which is kind of scary when you see like the regulators really pouring through your stories. So it's not totally unprecedented, and it's interesting when Chris Cox came out with a set of rules recently as to when the SEC will try to depose or subpoena journalists' work or subpoena journalists. He didn't say never. He said as a last resort. So they know that sometimes journalists might have to be involved in these things, and you know, it's something that we all face. I mean, there is no pure freedom of the press in this country. As you know, journalists spend a lot of time in jail. Probably your old colleague, right? You were
yes.
Ex-Times person, so you know that, you know, and people, you could go to jail. I mean, we are not exempt from the law.
No, but the notion that the main regulatory agency that is overseeing Wall Street is going to be from time to time subpoenaing journalists and looking through their notes, you know, I wonder what kind of chilling effect that might have. The press has not really.
If it's from time to time, I mean, it depends on how much. I mean, I think it's somewhat rare. I've not heard about it that much. I mean, there have been scandals involving business journalists and promoting stocks. The old place, the Wall Street Journal, had a very famous one, the Forster Winans case, where he used the herd on the street comp to promote a stock of a friend, where I believe he might have gotten kickbacks of money. I can't remember all the details, but it was a huge scandal at the Journal in the mid-1980s, and one where the Journal took very seriously, cooperated with not just with the SEC, but the Journal went out and actually covered it aggressively.
Which is the correct journalistic response.
Right, the best way to do it, and got it out and said, here's how, you know, we screwed up, here's how our guy screwed up, here's how our process screwed up, which is great. So there is precedent for journalists to be involved in stock scams. And by the way, if you know, I mean, listen, Dan Dorfman, once a very famous journalist,
No, we're not pure, I know.
Was investigated. He never was charged, though. In his defense, he was never charged, but he was investigated. Whether, you know, who knows how, you know, some of these stories got out there, you know, maybe used, I don't know. I mean, I don't want to get into the Dan Dorfman case because I don't know everything, but he was investigated. And so there is precedent for journalists to be investigated by the SEC.
When you look back over the whole period of Enron and WorldCom, how would you rate journalism with the whole coverage of Wall Street? Do you think we were aggressive enough, or are some of the problems have to be laid at the feet of journalists?
Yeah, I think some of it. I mean, I think I think journalists were pretty good with a lot of stuff. I mean, individual journalists, I should say. I mean, I think people at the New York Times and the Wall Street Journal did a great job covering scandals. I think that the problem did come with this sort of zeitgeist at the papers. If you remember what it was like during the 1990s, people like me, you know, investigative reporters, were not exactly the people you wanted around that much. You know, we were the sort of, you know, crazy ant in the cellar, so to speak. You know, I remember when I remember getting called into the office of a top editor at the Journalist, and he said, you know, on every story, I want you to put in why an investor should care about this. And I said, well, wait a second. I write stuff that, you know, it's not necessarily an investor-oriented story. I mean, I write about scams, you know, and you should care. You want me to say, you should care about this because you're getting ripped off? I mean, this is the type of stuff I do. And the bottom line is that the zeitgeist of the Times was that write stories about investments. And generally, you don't write negative stories about investments. People want to know about investments that work, not investments that don't. And I think management of newspapers failed. I think there were managers at the Wall Street Journal and probably other big publications that failed because they got caught up in the Times. The Times, everything was very positive during this time, and getting a negative story out there was something that they believed, you know, the public didn't want. And I remember I was talking to one of the editors at a major magazine, I won't say which one, who said, you know, they offered me a job, and they said the only problem is, you write all these negative stories. If you notice, all our covers have smiley faces on them. People don't want to buy our magazine with some dour-looking guy on it, that you just caught doing something bad.
Well, I think we've learned the hard way that, unfortunately, there's not so many good stories to tell. I've been fortunate to have CNBC reporter and Newsweek.com columnist Charlie Gasparino as my guest today. Thanks, Charlie, for being on the show.
Thanks for having me.
We'll be right back.
Some people think of New York as the world's second home. The City University of New York, with students coming from 90 countries and speaking more than 155 languages, is the world's first university. Find us on the web at cuny.edu or call us at 1-800-CUNY-YES.
It seemed like a good idea at the time, forcing Wall Street firms to finance their own competition in the form of new, more aggressive research firms that wouldn't be riddled with conflicts and could speak their mind about the true potential of a company's stock. However, there's no such thing as a foolproof system. If someone is determined to behave unethically, they'll find a way to get around the rules. Stock research is no exception. Where does this leave investors? They're still better off than they were before. The presence of new competitors in the field at least increases the chance that honest opinions will be voiced. A further tightening of the rules would also help. Even independent research firms should be forced to disclose any potential conflicts of interest they may have. But the bottom line is, until investors indicate that they truly value independent thinking and are willing to put their money where their mouths are and pay for more of it, research will be subject to manipulation in the name of the highest bidder. For USA Inc., I'm Sarah Bartlett.